Y'all, I've seen so much information about interest rates in the last, let's say, week that is accurate, but is lagging. It is delayed. And I want to actually go over a couple of charts here and show you why here at First Bank, and for myself in particular, why it seems like we are generally always ahead of the trends when it comes to pricing and locking our clients on interest rates. So the big news over the last week was that there were several economic reports, and Friday that concluded with the BLS job reports coming in significantly weaker than what was anticipated, and the unemployment rate going from 4.1 to 4.3% when it was expected to stay flat at 4.1. And as we've discussed before, the Fed does not like to be surprised. The markets do not like to be surprised. And so when they are surprised with negative data, most of the time that's going to be in our favor for interest rate pricing. But you have to be ready to strike when that moment hits. Tons of people are always trying to time the markets and lock, and usually just don't have the data or the technology in order to do that effectively. So while I have seen a ton of people posting late Friday, yesterday, and today talking about rates being lower than they've been since December, I was talking about it on Thursday and was saying, if you look back at I guess you can't look back at my stories from Thursday now, but on Thursday I was saying, hey, tomorrow, Friday, this is probably going to be the day to lock depending on what happens in the market. So here's what I want to be able to show you, and hopefully this will make a little bit of sense of why it's important to be ahead of the game, use technology to be able to do that. And I think that this is going to be helpful, obviously, for real estate agents. This is integral for you to be able to have confidence in your lending partner and know that not only are they going to provide good service, but that they are going to lock your clients when it is best and not end up missing the boat. So take a look at these charts, and I'd love to hear what you guys think down in the comments. Okay, so what we're looking at right now, this is the website. This is called MBS Highway. This is a website that I subscribe to. It is not cheap. It is for loan officers and mortgage folks basically only on there. I'm not sure if realtors are allowed to get it or not. I think you have to have an NMLS ID to get it. But it shows us where treasury bonds are moving, and where mortgage bonds are moving and where treasury yields are moving. And so when we are looking at this, I've shared these screenshots quite a bit. We do not want to see on any day, we do not want to see mortgage bonds in the red or U.S. Treasury 10-year yields in the green, because if yields are higher, that means rates are higher. Those work together with mortgage bonds. If mortgage bonds are worth less, then that is bad for interest rates. So, but really, the crazy stuff that everybody was talking about has to do with stating that interest rates as of Friday were the lowest that they had been since last December. And when we look at the mortgage bonds here, we can pretty much draw almost a straight line from our pricing that closed on Friday back to the best times in December, and that is accurate. And you can see how along the way we've had valleys, we've had peaks. We had a big valley here in April. If you guys remember, we had some really bad, favorable job reports that turned out to be pretty much completely bogus, but we took the hit for them, and then things would get better and worse. But I want to actually go ahead and dive into what we've seen in the last month. So when we look at this is, like I said, these are our mortgage-backed securities or mortgage bonds. And on Friday, they reached a peak level of just under 100.9 basis points. And so the higher value is good for interest rates. And this right here, this at the end of the day on Friday was about the best time to lock, okay? Now, what we were watching was it closed so positively, and when we look at 10-year treasury yields, they basically did the same. We saw them go down, down, down. On Friday, really low. We were down here at 3.8. And then on Monday, we opened up, we had a little bit of this candlestick where they went lower and then came back up, and MBS Highway issued a lock alert. Now, when we're looking at this, and this is why the data matters so much, is that anybody that has knowledge of the industry and has this technology should have seen this coming, because when we were watching these intraday pricing changes, we could see that mortgage bonds, which is what we're looking at right here, we could see that mortgage bond pricing was starting to come down. We can see that treasury yields were starting to go up. They ended up closing just above the bottom here. But at this point, when this lock alert went out, it was approximately 1 p.m. on Monday. I went in and locked my entire pipeline at 10 a.m. on Monday, because as I was watching, I could see that we were going to start losing steam on our pricing. And here's what's happened. We've closed lower on Monday, lower again on Tuesday, and today we're trending as well. So if you did not lock Friday or Monday morning, then right now you're in float mode. You are hoping that if you've got somewhere between 30, maybe 20 to 30 days, that we're going to have more economic data reports that are going to come out, and that we're going to get back some of these gains. But I know, and I shouldn't say I know, but I have to assume that when I see a ton of lenders that are posting today and yesterday and going into to last week, that they may have been just a little bit behind the 8 ball on where we're at, right? So here's Monday, Tuesday, and Wednesday. So if you locked on Tuesday, you probably got a little bit worse interest rate pricing than you did on Monday. If you locked today, you got a little bit worse than you did yesterday or on Monday. So when you are working with your lender, I'm going to recommend that you ask them what technology they use to give the advice on interest rates. Now, in the long run, we are excited to see what's going to happen. We have a lot of room for treasury yields to make a run down. We definitely believe that's going to happen. We've got mortgage bonds have a lot of room that they could continue to go up. Y'all, if we look back and go even further back, and let's say we look at 2 years, we can see that there's a lot of room up here. I mean, we're at 102.7. We're only right now sitting at 100.33. So there's a lot of room that we can still go up. It looks like the Fed is going to almost for sure cut rates on September 18. The question now is it going to be a quarter? Is it going to be a half? And in between now and then, there are a lot of economic reports are going to come out. The market is going to be looking to be aggressive and stay out ahead of these. If you have any questions about this, please reach out to me. Y'all know I nerd out about this stuff, and I would love to share it.